Hi, good evening. This is Renesilo. I'm working in Saudi Morocco. This will be my video presentation for the cases provided for the week 17 to 18. With the provide case of Allied Components Company, as we all know, provided in the case analysis, Allied Components Company is a supplier of auto repair parts used aftermarket with products from Daimler, Chrysler, Ford, and other automakers. The Chief Financial Officer provided an estimated cash flow for the two projects, Project L and the Project S. Project L involves adding a new items to the firm ignition system line. It would take some time to build a market for this product, so the cash flows will be increased over time. On the other hand, we have the Project S that involves an add-on on the existing line, and its cash flow will decrease over time. Both projects have 3 years lives because Allied is planning to introduce entirely new models after the 3 years time. With the provided information, the expected net cash flows are as follows. As the year provided, it's start from 0 to 3, 0, 1, 2, 3 with the project L and project S. The zero year for project L is 100,000 negative, and for project S is $100,000 negative, and go on to the first year, which is 10,000, and the next year, the second year is 60,000, and third year is 8,000. So that's all for project L. And project S, on the first year, it's 70,000, then 50,000 for the second year, and 20,000 for the third year. To note that the depreciation, salvage values, net operating working capital requirements, and tax effects are included in these cash flows. Capital budgeting is a process which the firm decides which a long-term investment to make capital budget projects. Potential long-term investments are expected to generate cash flows over several years, in which the business determines whether the projects such as buildings or a new plant or investing in a long-term venture are worth pursuing. Oftentimes, a prospective project's lifetime cash flows and outflows are assessed in order to determine whether the returns generated meet a sufficient target benchmark. Capital budgeting is important because more than anything else, fixed asset investment decision chart a company course for the future. Conceptually, the capital budgeting process is identical to the decision process used by the individuals making investment decision. That involves to estimate the cash flows, interest and maturity value of the dividends in case of the bonds and stocks, operating such cash flows in case of the capital projects, and it assesses the riskiness of the cash flow, determine the appropriate discount rate based on the riskiness of each cash flows, and general levels of interest rates. This is called the project cost to capital in the capital budgeting. To be able to know the company cash flow of the two projects, identify capital budgeting similarities between the firm capital budgeting decision and the individual investment decisions, difference between the independent and mutually exclusive projects and payback period, identify net present value, and to help to identify internal rate of return. To be able to know the estimated cash flow for the proposed projects, project N involves adding a new item to the firm ignition system line. It will take some time to build up the market for this product, so the cash flows would increase over time. Project S involves an add-on an existing line, and its cash flows would increase over time. Both projects have 3 lives because Allied is planning to introduce it for, as mentioned, new models after 3 years. The regular payback for 3 critical deficiencies, it ignores the time value of the money. It ignores the cash flows for occurs after the payback period. Unlike the NBP, which tell us how much the project should increase shareholders' wealth, and the internal rate of return, which tell us how the project yields over the cost of capital. The payback merely tell us when our investment back. Discount payback does consider the time value of the money, but it fails to consider cash flows after the payback period, and it gives us no specific decision rule for acceptance. Hence, it has the two basic flaws. In spite of the deficiencies, many firms still calculate the discount payback and give some weight to the making capital budget decisions. However, payback is not generally used as a primary decision tool. Rather, it's used a rough measure for project liquidity and riskiness. The MIRR, which is the modified internal rate of return, does not always lead to the same decisions as a net present value when mutually exclusive presents are being considered. In particular, small projects often have a higher MIRR, but a lower NBP than the larger projects. Through the modified internal rate of revenue is not a perfect substitute for NBP, and NBP remains the single best decision rule. However, MIRR is superior to the regular IRR. If a rate of return measure is needed, then the MIRR should be used. The project else involves adding a new item to the firm ignition system. It will take some time to build the market of this product, so the cash flow would increase over time. The project S involved an add-on to existing line, and its cash flow would decrease over time. Both projects have 3 years. If the project L and S are independent, then both should be accepted because both add to shareholders' wealth, hence to the stock price. If the projects are mutually exclusive, then the project S should be choose over L because S adds more to the value of the firm. Now, assume that L and S are mutually exclusive. In this case, a conflict might arise. First, note that IRS is equal to 23.6%. It's greater than for 18.1%. Therefore, regardless of the size of the weighted average cost of the capital, which is we usually call WACC, a project S should be ranked higher by the IRR criterion. However, the NBP profile should the NBPL is less than the crossover rate. Therefore, the WACC less the crossover rate says that WACC is equal to 77%. The NBP rule says L, but the IRR rules say S. Thus, if the WACC is less than the crossover rate, the ranking conflict occurs. However, the NBP and the IRR always give the same accept or reject decision for independent projects. So the IRR can be used just well as NBP when independent projects are being reevaluated. The NBP versus IRR conflict arises only if mutually exclusive projects are involved. Project L has $100,000 investment has not been recovered for the end of year 2, but it has been more than recovered by the end of year 3. Thus, the recovery period is between 2 to 3 years. If we assume that the cash flow occurs evenly over the year, then the investment is recovered for $30,000 over the $80,000 is equals to 3.78 is 4.4 into year 3. Therefore, payback for project L is equal to 2.4 years. Similarly, payback for S is 1.6 years. Based on all the information provided, I assume my assessment on the exercise or the GBS provided. Hopefully, I answered some of the queries or some of the questions provided, and hopefully you enjoy, and hopefully you'll be my professor on next year or next semester. Thank you and goodbye.